A brothel in an upscale neighborhood can pull in more than $70,000 a month, while an identical operation in a low-income area barely clears $8,000. The gap has nothing to do with the service itself, and everything to do with the cost structure almost nobody outside the business ever sees. Nobody knows exactly how much this market moves in the United States, because most of the activity happens completely off the books, with no tax filings, no registered business license, and no reliable government statistics tracking it. Independent researchers and industry watchers estimate that the broader escort and companionship economy generates somewhere between $3 billion and $6 billion a year nationwide, a figure that keeps climbing quietly while almost nobody discusses it in public. That growth is not accidental. Messaging apps and online listing platforms have completely reshaped how this market operates, letting a house attract clients without relying on street visibility or word of mouth. That shift lowered marketing costs, but also multiplied competition, since anyone with a bit of capital can now try to open a similar operation a few blocks away. Demand exists across nearly every income bracket, but it behaves in completely different ways, depending on where a house is located. And that is exactly where the first real discovery of this investigation begins. Two operations that look almost identical, selling the exact same type of experience, can produce financial results that barely seem to belong to the same industry. In upscale neighborhoods, clients pay for discretion, atmosphere, and security almost as much as they pay for the service itself. A well-located house near business districts and high-end hotels, with careful decor and a loyal client base, can charge hourly rates between $300 and $600, serving executives, business travelers, and professionals who would rather pay more than risk any kind of exposure. In lower-income neighborhoods, the logic flips completely. Average pricing drops to somewhere between $40 and $80. Because competition is fierce, clients have far less disposable income, and constant turnover has to make up for the lower price through sheer volume. A house operating in that environment survives on movement, not margin. This gap between neighborhoods does more than change the price tag. It completely reshapes the cost structure, the type of security required, how the operation shields itself from law enforcement attention, and even the profile of the women working inside each house. And before understanding what actually stays in the bank at the end of the month, there's a more basic question that has to be answered first. What does it really cost to open a house like this, whether in a wealthy neighborhood or a struggling one? Opening a brothel in an upscale neighborhood typically requires an initial investment between $150,000 and $300,000. Most of that money does not go toward furniture or decor, as most people assume, but toward renting a discreet property in a desirable area, usually paid with 6 months of security deposit up front. Since few landlords will rent directly for this purpose, forcing many operators to register the lease as an event space or a short-term corporate rental. On top of that comes the renovation needed to turn an ordinary apartment into something that feels like a luxury suite, with proper lighting, climate control in every room, and reinforced soundproofing, plus private security, internally monitored cameras, and a screening system that filters clients before they ever walk through the door. From signing the lease to welcoming the first client, the entire setup process for an upscale house usually takes between 2 and 4 months, depending on how quickly renovations and staffing come together. Owners also need to set aside enough working capital to cover 3 to 6 months of operating costs, the stretch of time it takes to build a reliable client base, when revenue usually falls short of covering every fixed expense. Without that financial cushion, many operations shut down before completing their first year. In a lower-income neighborhood, the initial investment drops sharply, usually landing between $20,000 and $50,000. The property is cheaper and easier to rent. Renovations are minimal, often limited to paint and makeshift partitions, and security, when it exists at all, comes down to 1 or 2 informal guards paid by the day. But that upfront savings comes with a cost later. Without structure, discretion, or client screening, the risk of violence, unpaid clients, and conflict with neighbors runs much higher. In both cases, there's an expense almost no ordinary business owner ever has to plan for: recurring payments to keep the operation running without interference, whether through informal arrangements in the area or payments made to whoever could shut the doors at any moment. That cost varies enormously depending on the region, but rarely drops below $2,000 a month and can climb past $10,000 in more heavily watched locations. After all of that investment, the house finally opens. And that is when the real operation begins. Money starts coming in every single day, almost always in cash. And how that flow gets managed decides whether the business survives or collapses in its first few months. Money in a brothel comes from 2 main channels: a fixed percentage the house keeps from every visit, usually somewhere between 30 and 50% of the price charged, and extra revenue from drinks, add-on services, and extended packages, especially in upscale houses, where clients are far more willing to spend money once they're already inside. In a well-run upscale house, it is reasonable to estimate between 8 and 15 visits a day, spread across several women working staggered shifts, with heavier traffic on Thursdays, Fridays, and Saturdays, when business travel and corporate events push demand higher. Multiplying the average rate by the percentage the house keeps, estimated gross monthly revenue lands between $70,000 and $150,000, a number that looks impressive at first glance, but is still far from representing actual profit. In a lower-income house, visit volume tends to run higher, sometimes reaching 20 or 30 a day, especially around paydays. But the lower average price means estimated gross monthly revenue falls between $8,000 and $20,000, a much smaller figure even while operating close to the physical limit of the property. This is where most people get the math wrong. A significant portion of that revenue never turns into profit. Rent, security, informal protection payments, cleaning and hygiene supplies, condoms and health-related items bought in bulk, bedding changed daily and sent out for laundering, electricity for a property running almost around the clock, and constant maintenance of cameras and locks eat up a huge share of the cash every single month. There's also a hidden cost most outsiders never consider: staff turnover. Women coming and going frequently means recurring advertising costs, an adjustment period for every new hire, and often the loss of loyal clients who prefer sticking with the same person. Keeping a stable team matters just as much as keeping the property in good shape, and that comes with a price that rarely shows up on any spreadsheet, but shows up fast in the following month's revenue. When an important client stops showing up, when law enforcement steps up patrols in the area, or when a competitor opens a few blocks away undercutting prices, revenue can collapse from one month to the next. And fixed costs do not disappear along with it. Rent, security, and informal arrangements still come due every month, no matter how many clients showed up. After adding up everything that goes out, one question remains that no owner answers willingly. What actually stays at the end of the month? The number about to come out is the reason some of these houses shut down before their first anniversary, while others keep quietly profiting for more than a decade without anyone on the outside ever suspecting it. If you want to keep uncovering the financial reality behind businesses most people would never dare investigate, hit like right now. It helps documentaries like this one reach more people. And now, finally, the number that changes everything. After subtracting rent, security, informal protection payments, supplies, and constant staff turnover, an upscale house generating between $70,000 and $150,000 a month typically keeps a net margin estimated between 25 and 35%. That works out to an estimated monthly net profit between $17,000 and $52,000, depending heavily on occupancy, client loyalty, and how well the owner manages to negotiate lower fixed costs over time. A lower income house, even generating far less, between $8,000 and $20,000 a month, operates on thinner net margins, estimated between 10 and 20%, because fixed costs weigh proportionally much heavier on a smaller revenue base. Estimated monthly net profit in these cases lands between $800 and $4,000, an amount that often barely covers the risks taken on every single day. Return on the initial investment also shifts dramatically depending on the neighborhood. In a well-located, well-managed operation, invested capital can be recovered in 8 to 14 months, a competitive timeline for this type of business. In a lower-income area, despite the much smaller upfront investment, payback usually takes longer, between 12 and 24 months, precisely because the margin per visit is so thin that any setback eats into the cash available that month. And the real risks go far beyond competition: violence, extortion, dependence on informal arrangements that can shift at any moment. Constant staff turnover and the legal exposure of running this kind of establishment put this business in a risk category, well above any traditional retail shop, restaurant, or gym. Industry estimates suggest a significant share of newly opened houses shut down before reaching 2 years, usually because of poor cash management. What separates the houses that thrive from the ones that close within months is not just location. It comes down to the ability to manage cash flow, keep a stable team, negotiate solid security arrangements, and reinvest part of the profit into discretion and infrastructure instead of pulling out every dollar the moment it comes in. Is it worth it financially for someone willing to take on the risk and run things with real discipline? The numbers say yes, especially in upscale neighborhoods, where the margin offsets much of the exposure. But the price paid in security, legal instability, and personal strain is steep enough to explain why the vast majority of people never come close to this kind of operation. The biggest discovery behind this market has nothing to do with the moral judgment most people make from the outside, and everything to do with the financial engineering hidden underneath it. Two houses selling the exact same type of experience can produce completely opposite results, and the difference is never just about the hourly rate. It comes down to location, cost, structure, and the ability to manage a cash-based business that runs every single day with zero margin for error. An upscale neighborhood does not guarantee automatic profit, just as a lower income area does not doom every operation to fail. What actually decides the outcome is the management happening behind closed doors, something few industries demand with this much intensity, precisely because it operates with no institutional safety net when something goes wrong. Once the numbers are laid out, it becomes hard to look at this kind of business as something simple or as something purely moral. Behind every house sits a quiet spreadsheet, deciding who survives and who shuts down, hidden behind a front that most people would rather not even imagine exists. In your opinion, does the profit gap between an upscale neighborhood and a low-income one simply reflect the area's buying power? Or does the way these businesses are managed matter even more to the final result?